Hey, good morning, everybody. Welcome back to the Mic Drop Show. This is where we talk about real estate, real freedom, and real results. And I'm your host, Mike Morawski, the multifamily bounce back coach. Hey, I'm your investor, educator, and favorite deal sourcing, cash flow obsessed guide through your wild world of multifamily real estate. Hey, listen, from interviews with eight-figure investors where we break down deals about raising capital, war stories from the field, this is the place to be every week, Wednesday morning. Hey, this is the show for professionals who want to go from paycheck to portfolio. So if you're feeling this energy and you don't forget to subscribe, smash the like button, follow us wherever you're watching or listening from. If you've got questions, drop them in the comments this morning or DM me personally, and your topic might be the next one on the Mic Drop Show. This is where we go live every Wednesday morning. This is your weekly wealth workout. All right, let's get into it this morning. Solo episode today. I have 3 or 4 questions that have come in over the week, and I really thought that it would be advantageous for us all just to kind of talk about these and share in these questions a little bit. One of the questions I've been getting a lot from limited partners, LPs, in multifamily investing, that passive investor that's coming into a syndication is, are there separate platforms to review the deals? And as a GP or an operator, what we do is we have a platform set up. It's a deal vault where when we have an investor who has an interest in investing in one of our opportunities, one of our properties, is we'll upload all the data there. So if you go to the investor portal, you should be able to find a webinar that was done, the slide deck for that particular offering, an executive summary, which is typically a 1-page sheet, just tells you about the property, the location, the numbers, what the returns are going to look like. It's a brief format before going into detail. We also put the underwriting in there. We put any updated financials. So on a monthly basis moving forward, for transparency's sake, we will upload the current rent rolls and the operating, the P&L T12s, so that you are always abreast of the updated numbers. And then we also have the offering documents in there. The LLC agreement, the PPM, these are the documents as a LP that you sign when you come in and you partner in one of these syndications with us. But you have all your information there that will help you do your due diligence, right? I really believe that every investor that invests in one of these opportunities needs to do their own due diligence. So we spend a lot of time when we're buying one of an asset, going through all of the books and records, and not just recent, but for 24 to 36 months back. We want to see trends. We want to see tenant trends, rent trends. We want to see expense trends, and we look at all that. So we do a heavy due diligence. We also do a big physical due diligence. Unfortunately, when you do physical due diligence, you don't catch everything. You do the best that you can, but you try to get as much as you can. But when you take over, there are things that happen. Like you might have air conditioners that go out, or you might have other issues with tenants where they move out of a unit. Now, all of a sudden, it's in worse shape than it was when you walked through the property because they abused it. But there are things that you have to look at. But as an LP, do your own due diligence. Vet the sponsor, vet the deal, and make sure that you are comfortable before investing. Every opportunity offers different risks. Every opportunity has an inherent risk with it. So every opportunity has different risks, has different investment return profiles, and do your due diligence when you're looking into these. I got another question, and it was kind of pre-framed to say that this is weird to ask, right? But by a potential investor. Is it okay to work with a different syndicator if they're invested in other syndications? And it absolutely is. I'm a huge advocate of diversification. We've heard for years about diversification in stocks and bonds, right? That you should have a well-balanced portfolio, that you should have some money in stocks, some money in bonds, maybe even some money in precious metals. But, when it comes to real estate, I think that diversification in real estate is really important as well, to give you that well-rounded portfolio. You should have some money in stocks and bonds, have some money in metals, maybe have some money in gas and oil. But when it comes to real estate, different syndicators, different opportunities. Maybe you're in multifamily, maybe you're in self-storage as an investor. But when you spread your risk, you get a balance. And that balance is what helps you produce not only cash flow, but it also helps you produce that long-term wealth aspect. When we work with our LPs, what we're really trying to accomplish is four things for our limited partners, for our private investors. One is preservation of capital. As an LP, you come in one of these offerings and you become a member of the LLC. That LLC goes and buys the real estate. Now your preservation of capital is directly related and directly in the brick and mortar. The second thing that we do is we provide cash flow. We want our LPs to see 7 to 9% a year in cash flow on the assets that they're invested in. And that's considered a preferred return. And now, even if you're not getting your preferred return today, right? Because there's some deals that have paused preferred returns, that doesn't mean you've lost it. That just means it's getting delayed or deferred to the back end. And when that deal exits or sell or refinance, you're going to get a catch up. So you'll get caught up on that preferred return. The third thing that we accomplish or work towards accomplishing is long-term equity, right? This is where you get your biggest investment return, and that happens at the end. That happens typically when we exit a deal or we refinance. I think that every syndicator out there today is in hopes that the interest rates come down. I believe that if interest rates come down, that there's going to be some opportunity to take some of these deals that have been acquired over the last year, 2 years, that have been in the 6% interest bracket, or maybe have some floating rate debt on them or bridge debt. And if they come down below 6%, there's going to be huge opportunities for the refinance market, which is going to open up a lot of cash and a lot more cash flow for people. And then the fourth thing is tax benefits. I'm not an accountant, and I don't know a lot about what was all in the big, beautiful bill that got passed. But what I do know is that 100% bonus depreciation is back. And as an LP coming in certain deals, you're going to have the ability to write off 100% of your investment. Let me tell you a quick story. I met a chiropractor a couple of years ago at an event, and the event, he was telling me, he said he was so proud of this. He had just bought a lake house, and he said, I paid cash for it, $800,000. I said, that's interesting. Good for you. That's really a great thing for you, for your family. But do you know that your money is dead? You just spend $800,000, put it into a piece of real estate that's doing nothing for you. Even if it's appreciating at, 3% a year, you're still losing money. Because if inflation is 4, 5, 6%, you're going backwards. Why would you not take a portion of that money? Let's just say you refinanced and did a cash out refinance, pulled out $400,000. Took that $400,000, put it in a syndication over here. You got 7% cash flow, another promote when we sell the deal on the back end, projected return, let's just call it 17% per year. And then the tax benefits. You could be earning about 20%, low 20% return on that investment. And his objection was, well, but I'm going to be at a 7% interest rate, but you're making 17%, 20% on that money. You're offsetting that. So you're still growing your money. When we have equity in a property that is just sitting there, it's dead equity. So why not capitalize on that equity and put it into a syndication that can help you build that long-term wealth? So the tax bill is really going to help. So here was the point behind it. He takes $400,000, invests it. He called me a month later and said, hey, I just got a tax bill for $125,000. Well, at the time, the bonus depreciation was about 60%. I said, well, you could pay the government that $125,000, or you could invest that 125 into a syndication and write off about $75,000, $80,000 of that. And he wound up investing and being able to access that tax depreciation and be able to save on the money that he would have just spent on taxes, where he got the write-off. So, there's different strategies. So if you're somebody who's a high income earner and you're looking for tax strategies, those opportunities exist in these syndications. If you're somebody who is looking for cash flow, those opportunities invest in syndications. And if you're looking for that long-term generational wealth that you can build up, maybe, and then when you exit a deal, maybe you do a 1031. So there's all kinds of strategies that you can work around each one of these. So, hey, if you're somebody who's sitting on the sidelines, maybe has some cash, maybe has some debt equity somewhere, and you're looking for ways to use that or to grow your wealth, you know what? We are in part of the market cycle right now where we're going to come out and you're going to be at the front of the bull run and be able to really create some wealth for yourself. So consider that. And you know what? Give me a call and we could have an offline conversation about your particular situation. Your particular situation might not work, and that's okay, but at least have the conversation and get the ideas and know if it does work. Here's another question that I got, and I found this one to be a little bit unique, but somebody's asking, how do we as syndicators screen passive investors? That's an interesting question because there's a couple of ways that we look at investors. Not every investor is right for what we do. Not every investor we want in our opportunity or want to work with. One of the ways that we screen them is a simple process called, are you accredited or non-accredited? And for those of you that don't know what that is, an accredited investor is someone who has a net worth of $1 million minus their personal residence. So you can't include your personal residence in that. But if you have a net worth of $1 million, you're an accredited investor. The other option is, and you only have to fit into one of these two categories, is if you're single, you've earned $200,000 the last couple of years and expected to earn that again. If you're married, you've earned a combined income of $300,000 and expected to earn that again. So if you fall into one of those categories, you're accredited. Now, there's different opportunities, different offerings that you can go into for accredited and non-accredited investors. As a syndicator, we don't care if you're accredited or non-accredited. I actually like non-accredited investors because over time I can help them become accredited, which is really a powerful thing to be able to do for other people. So whether you're accredited or non-accredited, doesn't matter. Come talk to us. Let's see if we have an opportunity that might work for you that you could fit into, or one that's coming up that in the near future you could get into if you're non-accredited. But the goal is to help you build wealth. And if we can help you do that through a multifamily syndication, a light industrial syndication, a self-storage syndication, those opportunities exist out there. And then the fourth question that came in this week was, what KPs do to report investor quarterlies? So that's really a great question. We're in a business where we need to be very transparent. And whenever we are being stewards of investors' dollars and trying to preserve that capital for them, what reporting do we do? How transparent are we? Well, the first thing that our group does is every month you're going to get a newsletter. Good or bad, you're going to get an information report that comes out. It's going to talk about occupancy, traffic. It's going to talk about the length of time units have been down, what repairs and maintenance need to be done. And we're going to talk about financials. What have the collections been? What is the accounts payable look like? What is the T12, that profit and loss, look like? And also the reports around balance sheets and that. So you're going to get to see all that on a monthly basis. We publish that. We put a newsletter out. And our group actually does a video recording. So we'll do a video recording of that event every month. Gives you, if you're in the car, you can just listen to it and get the update. Once a quarter, so every 90 days, and it gets a little time consuming, but you know what? We do this for our investors because we want to serve them at a higher level. But what we do is we do a quarterly investor update. So we'll come to a Zoom group, we'll come to a Zoom meeting once a quarter, and we'll talk about what happened over the last 90 days. And we'll talk about what the goals are for the next 90 days. And then all of this information, again, is published. It's updated into the investor portal. So if you ever need to go back and refer to something that was talked about or a report that was put out a couple months ago, that data is going to be there for you. So, transparency in this business is very important. I've talked to a couple of LPs recently who are in other syndications and have said, they have stopped reporting. And, I find that sometimes syndicators will stop reporting when times get tough and the waters get rough. But what we want to do is we want to, no matter, like I said at the beginning, whether it's good or bad, you're going to get that report from us because we want you as our partner, because you're partners with us, right? We do all the work and we're handling the day-to-day activity, but you're our partner. And being our partner, you need to be updated. The other thing that we let our partners do is if you ever want to sit in on an asset management call, and an asset management call is where on a weekly basis, we're on with our property management team, our boots on the ground, talking about 13 different fundamentals. And we want to make sure that the operations are being run at a very high standard. And we set goals week to week based on what has happened over the last week, 2 weeks. And it's the same thing I do with my coaching clients, right? Is I take my property management team and we set those accountability standards. And then we come back and check in on those goals that we set the next week. So if you ever want to sit in on one of those calls with us and you're one of our LPs, you have the ability to be able to do that. So, all right, that's a wrap for today's episode. I hope that there were some nuggets here for you this morning. Today's episode of the Mic Drop Show. I hope that you're walking away with maybe a little bit of a mindset shift and maybe even some straight up blueprint for how to be an LP, how to vet a sponsor, how to vet a deal, how to come in. Listen, wealth doesn't happen by accident. It happens by design and by action. You've got to take action. Stop sitting on the sidelines, move forward. Put your capital to work for you today. So whether you're just getting started in the business, you're leveling up or scaling up, keep showing up. Keep showing up, getting information, getting knowledge, and taking action. So listen, if this episode gave you that value, do me a solid this morning. Smash the like button, hit the follow and subscribe button, and share this with somebody who's building a portfolio or wants to build a portfolio and get away from that W-2 or just their paycheck. And if you've got questions or topics that you want us to cover, drop them in the comments, send them to us by email. We'll get those covered for you in the next event. So remember, same time, same time, same channel next week. But until then, stay focused, stay cash flowing, and keep stacking those doors. And one last thing, today's episode has been brought to you by Sync VA. Sync VA is your partner to help you to bring good quality talent to your team. So if you're somebody who's looking for an executive assistant, if you're somebody who's looking for an editor for your social media content, if you're somebody who's looking for support staff or a closing coordinator or somebody to help you just do those day-to-day activities, Sync VA wants to partner with you to find you that perfect VA, that perfect fit for you. So if you're looking or on the search for a virtual assistant, reach out to us, reach out to Sync VA, and we will work with you to get that person for you. So remember, same time, same energy next week. But until then, stay focused, stay cash flowing, and keep stacking those doors. Have a great week, everybody, and we will see you soon.